Hello, hi everyone. I'm Colin from the research team. I know we have overrun the time by quite a bit, so I will try to keep things short and keep things fast, so please bear with me. Okay, so back to this presentation, I think if you look across this year, markets has been very challenging for investors, for you and for us alike. So the market narrative has shifted from one of strength to one of caution. And as you look around all over us, major asset classes are falling quite rapidly. And so how, under this environment, how should you invest? So my presentation here, I will talk about some of the key points of how you should do or what you should employ for your portfolio practices, as well as some of the asset allocation strategies for investors to combat this volatility. So in the next slide, let's look at more in detail of what has happened recently. Next slide. So what has happened is a question that I get, our team get very often for investors as well as from the advisors. So if you look at a chart on your left side, you can see that markets, both equity and bonds have fallen by about 20% in the year to date. That is very drastic. And something interesting here is if you can look at the other chart, right next to it is the correlation between the equities and bonds. In fact, for global as well as the US, bonds and equities have flipped positive and in fact has been rising in the year to date. So what this means for investors is that bonds are essentially a less effective hedge for equities after this recent dynamics. So is this something that investors should worry or should be concerned about? So as a house, we think no, and I'll share two reasons why. Next slide. Sorry, next slide, please. All right, so in this slide right here is the first reason. So is this a common occurrence? It's something that we ask ourselves first and foremost. So in short, no. Based on our research, what we find is that if you look across the past 30 years since 1990, what we find is that whenever stocks and bonds start to fall, it is when inflation starts to rise, central banks start to hike rates, as well as during slowdowns and recession. So aside and outside from all these different dynamics or different scenarios, stocks and bonds falling is quite an uncommon occurrence. And I will show you two statistics right here. So if you look at look at over the past 30 years since 1990, there were only 76 out of almost 390 months that stocks and bonds fell. So as a percentage, that is about 20% of the time. So if you look at things from a quarterly perspective, you'll find that there were only 19 out of 128 quarters which both asset classes fell together, and only about 15% of the time. So statistics show that this is in fact a rare occurrence. And in the next slide, I'll show you the second reason why. So the next important question we have to ask ourselves is how long does this usually last? And as shown from this chart over here, you can see that this, in fact, is a very brief reaction as stocks and bonds tend to rebound relatively quick. As you can see from the chart here, stocks and bonds rebound about 1% 3 months after and about 6 to 7% 12 years out. So something even more interesting is that consecutive months of negative return for stocks and bonds are relatively rare. In fact, it is only almost 95% of the time stocks and bonds fell for only 1 month only. So if you look at as a whole, the reasons why we are not concerned about this situation is that it is a relatively uncommon occurrence, and this is also something that is fairly brief. So next slide, please. And having said that, let me now share some important reasons why investors should stay active during this turbulence and some of the important portfolio practices to combat volatility. Next slide, please. So starting with diversification, which is one of the most important practice investors can employ. And I'm sure the previous couple of speakers have also narrated and talked about this point. But I just want to share some important tips on diversification. And to simply put, diversification can reduce portfolio correlation and ultimately prevent major drawdown risks. And the reason why we believe diversification is an important tool in today's context is that if you look around us, look at the macro risks, look at the event risks around us, such as the Russia-Ukraine war, inflation, aggressive central bank, and growth slowdown. All these are in fact localized risks or more severe in one region over the other. And this makes diversification a very important tool to reduce the exposure to all these different localized risks. And as shown from the table right here, which is a correlation matrix between the major bonds and major equity segments over the past 1 year and 3 years, you can clearly see that the correlation differs across these different major asset regions. So I'd like to highlight 2 things from this chart right here. So first, as shown within the green box, which is the 1-year correlation between the equity markets. So as you can see, the 1-year correlation between the equity markets, as shown in the green box, are relatively low, as highlighted in blue. And what this means is that investors can achieve quite effective diversification just by spreading allocation across equity region and just not sticking into one equity region. And the second thing I want to share is highlighted on the red box right there, and which is the 1-year correlation between major stocks and major bond segments. So as you can see, the correlation is even lower for the major stocks and major bond regions, especially for safer bond segments. So what this means for investors is that just by allocating away from equities and into bonds, investors can achieve even more effective diversification and reduce the portfolio correlation much more. So to link back to what I mentioned earlier in my previous segment, while the correlation for stocks and bonds have turned positive, these bonds are still a good asset class to invest in a diversified portfolio, because I think as investors, we should not forget that bonds are a return-generating asset class. It carries yield or carries a positive carry. And lastly, it has the ability to dampen equity market drawdowns. So next slide. So in my previous slide, I briefly mentioned the merits of diversification across region and across asset class. But there are also many other ways investors can diversify. For example, diversification through sectors, through styles, as well as through teams, be it in general teams or in more specific teams. Next slide. And the next important portfolio practice for investors is rebalancing. So a rebalancing strategy that are well planned works best when the markets are choppy, such as what we are seeing right now, when asset class can strongly outperform in one day and strongly underperform the next day. And unfortunately, this is something that we are being dealt with right now, the cards that we've been dealt with right now. But nonetheless, rebalancing is a strategy that works very effective now because of 2 main reasons. First, it enables investors to maintain the diversification choices through the changing market condition. And what I mean by that is essentially by rebalancing, an investor is actively resetting the portfolio to its intended diversified choice. And instead of letting the allocation drift, which means that the portfolio becomes more concentrated in a certain segment. And for the second reason is that rebalancing can translate to a more stable portfolio risk profile during volatile times such as this, instead of one that mirrors the market. So for us, we ran a simple backtest to track the returns of a buy and hold strategy, which is no rebalancing versus periodic rebalancing over a quarterly period, a semi-annual period, as well as an annual period. So the results are shown on these 2 charts right here. And as you can quite clearly see that over a 20-year period, periodic rebalancing produces returns of around 5 to 10% stronger than the buy and hold strategy of no rebalancing. That is including the transaction cost per rebalancing. So once again, periodic rebalancing produces stronger return over the long term relative to a buy and hold strategy. And this example uses a calendar rebalancing, and investors can also consider a range-based rebalancing, which is rebalancing triggered when your asset allocation exceeds a pre-specified range. Next slide. And another important practice I would like to highlight during volatile times is to focus on the right asset class. And by right asset class, our definition is that one asset class should enhance the portfolio risk return profile. And with that regards, we think that crypto is a poor investment vehicle, as shared by my colleague JP earlier. And the reasons are listed on this screen right here. First, it lacks fundamentals. Next, it is a not so reliable hedge for inflation as we have seen clearly. And thirdly, the global liquidity is receding, which means that the money, speculative money that has been pumped in the past couple of years are now receding, pulling the asset class lower. And next, within cryptos have high idiosyncratic risk as well as high volatility. And most importantly, it is a reflection of the greater food theory. So the next important point that I'd like to share is during this volatile period, investors should remain focused on the longer term horizon. So I believe many of you and many of my fellow investor peers do sometimes during market volatility have the tendency to exit all the position and put everything in cash. So while we acknowledge that cash in the near term can tactically outperform stocks and bonds because it is more resilient to capital destruction, but over the long-term period, cash typically underperforms, and in real terms, even more severely. So on the chart right here, you can see that we ran the returns of stocks, bonds, and a 60-40 stock bonds portfolio versus cash over various horizons, such as your 5-year, 10-year, and 15-year. And what we found is that over all these periods, in fact, cash significantly underperforms stock bonds as well as the 60-40 portfolio. And bear in mind that all these returns are nominal terms. So if you convert them to real terms, taking into account of inflation, which is very prevalent in today's situation, the real returns of cash is even much lower than the other asset class. Next slide. So having gone through some of the best practices for our portfolio, let me dig a little deeper. And in this section, I'll share a little bit on our managed portfolios as well as our asset allocation strategies to combat the ongoing volatility. So let me first introduce DPMS and MAPS, which is our managed portfolio solution. So at iFast, we provide the discretionary portfolio management solution, DPMS in short, for institutional clients, and FSM MAPS portfolios, MAPS in short, for our retail investors. So both are independently managed portfolio services that builds, monitors, and balance your portfolio for you. So both DPMS and MAPS features 5 different portfolios, each catering to different investor risks. Next slide. So our portfolio mainly invests in equities and fixed income through a very carefully selected, careful process of selecting the ETF as well as the funds. So for equity allocation, we adopt a GDP-weighted methodology, and that ensures that our portfolios are more diversified versus global benchmark. And as shown from this screen right here, you can tell by the comparison between our own portfolio versus, let's say, a MSCI AC World Index. The geographical allocation differs very much wildly. So in the MSCI Global World Index, it is highly concentrated in the US stocks, whereas ours is much more diversified. And for a fixed income allocation, as shown on the bottom pie chart right here, we are invested in major bond segments around the world, and we also have a larger allocation to safer bonds region, making sure that our portfolios are more diversified and also have stability in them as well. In the next slide, please. And across the different asset classes, we remain overweight equities over fixed income by 5%. So the decision to overweight equities stems from our view that the outlook for equities remains much more supported than fixed income. So for equities, what we have been seeing is that the fundamentals for both earnings perspective as well as a macro growth perspective remains positive. While we might see downgrades in the fundamentals, but growth numbers are still positive this year. And aside from that, valuations have retraced back down to much more palatable levels, and our forecasts indicate attractive long-term returns from several regions such as China and Asia, as Japan. Whereas on the other hand, if you look at fixed income markets, they have been very much challenged by the volatility in rates, and that means that the price for fixed income as a whole may remain volatile because of the uncertain trajectory in inflation. And on top of that, when we look at yields, no doubt they have been rising, but we do think that spreads have even more room to rise as well because of financial conditions tightening and growth weakening, and therefore we see more downside in fixed income. And overall, for all these reasons, we choose to allocate more to equities over fixed income. Next slide. So for equities, we prefer Asian equities, and in the regions such as China, Asia like Japan, as well as Japan itself. So as a result, we remain overweight on these areas, and to fund the overweight in this area, we have a deep underweight in US equities, as well as a moderate underweight in digital economy stocks. So for fixed income, our strategy here is to dial back on the aggregate duration for the fixed income regions and instead allocate to regions that are shorter duration but provide decent yield. So what we did was we reduced the allocation to EM hard currency debt and reduced the allocation from US high yield and reallocate them to Singapore-centric bonds. Next slide. So in terms of a style preference, as mentioned earlier by Terjin, we do prefer value stocks over growth. And as shown from this chart right here, value has significantly outperformed growth in the year to date, and for reasons that I mentioned by my colleague Terjin. So for our portfolio itself, we have initiated exposure to value stocks and, in fact, initiated exposure in our US as well as European equity sleeve, which has the largest two equity sleeve within the equity allocation. So right now, we are holding a barbell allocation towards both large cap growth as well as US value-oriented, as well as value-oriented equities within the US and European sleeves, as shown on this illustration right here. So the reason why we hold a barbell approach is that A, we want to express our positive view on value, but B, we also want to maintain exposure to the large cap stocks, which, in fact, what we found through our research, we found that valuations have now been retraced back to much more palatable levels. Fundamentals are still relatively strong for a lot of these large cap companies, and we also want to be positioned for an eventual recovery, and having a barbell allocation to these two factors allows us to be positioned in such manner. Next slide. So in terms of sector as well as thematic preferences, we are still bullish commodities and have initiated exposure to global natural resource segment. So the reason for our bullishness was highlighted by my colleague Chloe earlier, but in short, we see a positive supply-demand setup, which is bullish on prices for the near to mid-term. And like I mentioned earlier, the Russia-Ukraine war is, in fact, one of the key catalysts. And from this chart right here, you can quite clearly see that Russia-Ukraine as a whole makes up a very overwhelming share of the global supply of major commodity complex. And on top of that, we also see a long-term bullish case for commodity prices, and that stems from the long-term structural underinvestment as well as shift in priorities from the government to food and energy prices. And lastly, we believe commodities are, in fact, a very effective hedge for inflation and geopolitics. So with these three reasons combined, we are bullish on the commodity sector. And with that, I've come to my final slide. And before I end, I would just like to leave you with the key takeaways from my presentation, which are these 3 points right here. Do not be afraid or do not be overly concerned when stocks and bonds are falling, and also some key important portfolio practices for investors and our recommended strategies to inject resilience in the portfolio. And as such, thank you guys for staying throughout this presentation, and I'll see you again next time.